Welcome to ETF TV, your insight into the world of exchange-traded funds, issuers, and investments. I'm Margareta Hricova, and joining me today are Greg Benhaim, Executive Vice President of Product and Head of Trading at 3iQ, and Deborah Fuhr. Greg, Debbie, welcome to the show.
Margareta, thank you for having me.
Greg, great to see you. We're starting to see traditional banks participate more in digital asset investment products. Do you expect this trend to continue?
Yes, I certainly expect the trend to accelerate. What we're seeing is a natural evolution. As digital assets move further into mainstream finance, banks are becoming more involved. Traditional banks, particularly in Canada, they've been on the sidelines for the past few years, observing the space, waiting for regulatory clarity, building internal expertise, and educating themselves on how they can become more comfortable to directly participate. And now you're starting to see two approaches. One, they're including existing listed products on their platforms, or they're taking the opposite approach of building those products themselves. Our collaboration with Scotiabank on DXMC is a perfect example of that progression. It represents the first actively managed bank-sponsored crypto product in Canada and really is a signal that large financial institutions are willing to engage with digital assets because of the regulated, transparent ETF structure that exists and is highly utilized to distribute digital assets. I think several factors are going to drive this acceleration. First, client demand is strong both from institutional and retail investors, and it continues to grow as digital assets become more recognized as a new asset class. And now we all know that banks act as gatekeepers for a significant amount of capital here in Canada. They bring distribution, they bring scale, they bring perceived and actual risk management expertise that can help broaden adoption. So for all those reasons, we're pretty confident that banks not only are going to accelerate their participation in the industry, but they're actually going to accelerate adoption as well because of the vote of confidence that they're going to give to investors and allocators as they begin to participate. The conversations we've been having them have taken two approaches. First, many of them are trying to prevent assets from leaving their platform or their ecosystem, which they've seen happen, whether it's to Canadian or US products, specifically for digital assets. So, one, they're thinking of it from a defensive perspective. How do we make sure that assets within our ecosystem stay within our ecosystem? And if it's as basic as we should offer a Bitcoin ETF and we'll have a certain percentage allocated within a few of our multi-asset products, they're thinking about it from that approach. The other, which is a little bit more forward thinking, is recognizing the disruptive nature of the technology and the asset class, understanding that financial services is one of the primary industries that is ripe for disruption, and taking a bit of a forward-looking approach to one, capture some of that market share from their competitors, and two, help develop products to prevent that sort of cannibalization of their existing business lines. That's been a noticeable shift. Another one is what was once educational conversations. Every single time we were getting a call from banks or major financial institutions, it was, what is Bitcoin? What is Ethereum? What are digital assets? How would you think of including this in a portfolio? Basic questions that have evolved over time to them having an understanding and them trying to figure out what products best suit their current distribution, which is a dramatic shift. Like I can't tell you how long for the first 5 years of my career in the space, all I was doing was educating institutions on the asset class, and now it's okay, we're ready. What do you think we should launch? So that's those are the main trends that I see having shifted. And because of all those reasons, I certainly see banks participating more and more and more. What I'm hopeful for is that's going to lead to significant increased participation in everyday allocators and clients.
Canada has been a leader in regulated crypto investment products. Where do you see the next wave of innovation in digital asset ETFs and ETPs?
I think Canada has played a very important role in the evolution of regulated digital asset investment products. We were among the first markets to launch physically backed crypto ETFs, and that leadership really helped establish the ETF structure as a trusted way for investors to access digital assets within traditional portfolios. Because let's face it, the options that were available before were just not right for mass distribution. But if you look at where the market is today, I would argue that the first phase of crypto ETFs were really about basic beta exposure, single asset products that track something like Bitcoin, like Ether, and provide staking exposure when available. While these products were extremely important just to provide access more than anything, they've also become largely commoditized. The US has entered the space, Europe is a large player, Hong Kong and Asia are actively participating, and it's only going to continue to be commoditized. From our perspective, simply launching another single asset beta ETF isn't particularly interesting or additive to any of our investors. There's also the structural reality of Canada. It's a strong ETF market and it's a decently sized economy, but it's certainly not large enough to support an endless number of single asset crypto ETFs. And we have no intention of launching 20 single asset ETFs that may attract 10, 20, $50 million of capital at most. And you're starting to see that happen in the US, which is obviously the mecca of liquidity and capital in the world. Even some of the fringe assets, you would say, that haven't really developed their use case yet, really are struggling to gain traction. So we don't find that side of, call it innovation, particularly attractive. What we're more interested on is, and where we think innovation is going to come in the space is active management within the digital asset space. Digital assets are still young and they're a rapidly evolving market. They have different cycles, liquidity dynamics, sector opportunities compared to traditional assets. And frankly, they're more inefficient, which creates a lot of interesting opportunities for investors to be able to capture some additional upside while managing risk accordingly that they wouldn't potentially capture by simply buy and hold exposure, which is what you see from our existing ETFs right now. And really, that was the philosophy and the approach that we took when working with the Scotiabank and Dynamic team and building out DXMC. We thought, rather than offering another single asset product, let's focus on building a portfolio solution that can actively manage the broader exposure to digital assets, or the digital asset landscape, I should say. Looking forward, I think another major development will be the integration of digital assets into broader multi-asset portfolios. Historically, crypto's often been treated as a standalone allocation, but as the asset class matures, we expect that we'll begin to see more multi-asset indices, whether they're in balanced portfolios, alternative indices, or really eventually just an S&P 500 plus Bitcoin or TSX plus Bitcoin ETF that captures some form of weight of the equity side of things while also capturing the crypto market. We think that's particularly interesting because one of the most common questions we start to get now is, okay, we understand Bitcoin, we understand Ether, we understand the value proposition of crypto, but where do we put this in our portfolio? And rather than having advisors or allocators need to answer that question, I think the products will almost do that for them if they start including certain weights within multi-asset ETFs. So when you think about that answer more holistically, the next phase of innovation isn't really about more crypto ETFs. It's about how digital assets fit into broader portfolio toolkits. That means more active strategies, multi-asset approaches, and most importantly, continued collaboration with regulators to build products that are both innovative and appropriate for public markets. For me, Canada isn't about launching the 10th single asset ETF. It's about pushing the envelope of what an ETF structure can do with digital assets inside. So helping investors access the asset class in the most sophisticated way possible while staying within the confines of an 81-112 framework.
So many people talk about tokenization as being the next evolution of financial markets. What is your thought on this, and how do you see it impacting investment products in the financial markets?
Tokenization, big buzzword in the industry, often highly misunderstood. I think the best way first to explain what it is it's simply a new distribution rail for financial products. Tokenization in itself is not a product. All it is a new form of distribution. So many people frame tokenization as something entirely new, but in practice, it's simply an evolution of financial infrastructure, which we've had many times throughout history. A perfect example would be how electronic trading replaced paper certificates. It's kind of that sort of technological innovation. The real advantage is programmability, settlement efficiency, and global accessibility, all of which flows into just overall capital efficiency. Like capital efficiency that has never before been seen, and frankly is vastly underrated how much efficiencies this can potentially bring. So at 3IQ, we believe that tokenization is going to play an important role in distribution for financial products over time. So for us, it's key to figure out where our products can angle themselves within this tokenization framework to actually improve access or operational efficiency, not simply wrapping a product. Take our ETFs, for example. An ETF is a wrapper for Bitcoin or a wrapper for Ether. Tokenizing a Bitcoin ETF would effectively be rewrapping the wrapper to distribute it on chain, where everyone who's on chain already has access to Bitcoin or Ether if they're participating directly. So we don't think that's particularly exciting about tokenization, but there are many places where you will start to see improvements. Short term, I think tokenized funds will still operate within the existing framework and compliance requirements. So nothing's going to change except assets are going to move on chain and there's going to be a tokenized representation of those assets. Investor protections are still going to exist, regulatory oversight still going to exist, and frankly, those are going to remain essential to the long-term health of the industry and the development of tokenization from really the first inning of where we are today to where we think it can go. I think adoption is likely going to start with tokenized versions of familiar products such as funds, treasuries, credit instruments, namely, and then really it's going to evolve over time. Long term, I think what's more exciting is financial products rather than being built on the traditional rails and then having a tokenized wrapper built and distributed on the blockchain. I think products are actually going to be natively distributed on chain and skip the traditional rails entirely. And this is where you're going to start to see a real structural change happen, where you're going to start to see instant settlements, you're going to have programmability. Perfect example is if all of a sudden all S&P 500 ETFs are issued on chain and everyone has their own tokenized version of that index. All of a sudden you can have some sort of collateralization ratio for it where you can have every individual in the world participate by lending pools of capital towards people who want to borrow against their S&P 500 allocations. And it's no longer just prime brokers that are able to do it. Everyone can do it so long as it's over collateralized, which is likely going to reduce interest rates significantly because there's a huge amount of capital that's going to flow in and want to capture some of that lending. And it's going to likely increase price discovery as well.
Greg, thank you for joining us and sharing some very insightful comments.
Thank you for having me.
Thank you, Greg. And thank you to 3IQ for sponsoring this episode and to all of you for watching. To watch prior episodes and to see news from the ETF industry, visit us at etftv.net. Thank you.